Welcome back to Morning Trade Live. Time for Chart Master. Marley Kayden takes us through the fundamentals. Ducat takes us through the technicals. So, Marley, we start with all of these names that we're watching for next week for earnings, right? Domino's front and center for Monday morning. What should we be looking for from this Domino's report?
Well, right now the street is calling for EPS of $3.91. That would be down from $4.03 a share in the year-ago period. Revenue, though, expected to be up 4% year over year at $1.14 billion. Now, a lot of key drivers cited when you go through the reports, what to expect for Domino's earnings. One of the ones mentioned the most is the Parmesan stuffed crust pizza launch. This is a part of their new Hungry for More strategy. It did launch late in the first quarter of 25, but it likely boosted second quarter performance through strong customer satisfaction. They had high order mix and elevated check sizes because of this initiative. Also, they have a new DoorDash partnership. Now, this is supposed to, management says, expects to be twice as impactful as their already established relationship with Uber Eats. So that could have also aided in the company's performance. Also, global expansion. The company-owned and franchise store comps are projected to grow by 5.5% for the company-owned ones and 6.5% for franchise stores. And international markets like China and India remain major growth engines for them as well. International comps also expected to be up on the quarter. Domino Rewards program, a huge mention in pretty much every report. That drives about 40% of their U.S. sales. So Domino's has some really heavy brand loyalty here and has played a pivotal role in boosting their U.S. performance and customer engagement. Also, cost management. Despite inflationary pressures, Domino has a pretty disciplined capital return strategy. They've got more than $209 million in dividends and $329.5 million in share repurchases just last year. So it does demonstrate some financial agility on their part. Also, the analyst community remains optimistic about them. 27 analysts rate them as a moderate buy, 15 of those strong buys, and only one strong sell there. And UBS and Morgan Stanley both highlighted their just over 28% gross profit margin and their digital momentum as potential drivers here. Redburn Atlantic did warn of something interesting, though, Nicole. They warned about the adoption of these semaglutide drugs and what that may have done to their bottom line. So they did cite that. Other potential risks, rising commodity and labor costs could weigh down, shifting preferences towards healthier options and the rise of those semaglutides. And there are several ongoing lawsuits that could be affecting Domino's cash flow as well here. So those are some things to note. But overall, analysts expecting a 6.5% on average earnings surprise based on historical performance. And they posted a beat in 3 of the last 4 quarters, the last quarter beating by more than 5%, Nicole.
And look, I mean, the weight loss situation is a problem for across the board for many food types. But the costs that they may be facing in particular at Domino's or lawsuits, that's more Domino's specific. Let's see, Rick, about the chart. What a choppy, insane chart this has been.
That's a good headline, Nicole. Mostly trading within a range of about 400 to 500 for the entire year. You can see we hit our lows around 400. This area here, kind of a consistent low point here. But then 500, where we hit our 52-week highs, also seemed to be a rather persistent ceiling. So really not a lot of net movement during the past 52 weeks. Only about a 6%, about a 12% year-to-date gain, about 6% off of the highs now, just kind of stuck in the middle of this pattern here. In the more short term, we can see, though, that we have a downward sloping trend line starting from here and brushing up against this recent period of resistance here as price struggled to get above another resistance support area. You can see here that point near 475, our red line. First was a high point and then a low point. That was the breakdown area. We got stuck there again. You could also draw a longer term trend line starting with those lows that we saw in earlier this year, this low point here as well, connecting once again. Most notably as well, our April lows that we hit during the tariff news announcement here, it pretty much held firm. So that was a significant area to watch as well to the downside. If we were to look at our other studies, standard deviation channels and volume profile, price is around this area, 465, one of the more notable volume nodes. That's about where our moving averages line up too. So 465 would be a key supportive area. If we were to move higher and break above 475, volume starts to pick up again near 480.
Okay, thank you for that. Next up, should we take a look here at Lockheed Martin, which that reports on Tuesday? What are some of the estimates there?
So, Nicole, Wall Street expecting year-over-year decline in earnings on higher revenue when America's largest defense contractor reports on Tuesday. For EPS, they're expecting $6.50. That would mark a decline of 8.6% year-over-year. For revenue, they're expecting an increase of about 2.5%, up to $18.57 billion. Now, all four of its major segments are projected to post sales growth, led primarily by aeronautics and missile units. That's the expectation. So let's go through these. First, Lockheed delivered 72 F-35 jets to the U.S. government in May, but that was after several months of delay due to software improvements. So although they are expected to have boosted Lockheed's second quarter cash flows to some extent, the cost overruns and the withheld payments associated with those delays in prior quarters are likely to weigh on the earnings there. Impressive sales performance, though, from their business segments likely boosted earnings. They did have some lower equity earnings from the United Launch Alliance, ULA, owing to lower than expected ULA launches in the second quarter. That could have been an issue. Aeronautics specifically contributes 40% to the company's top line. That will likely deliver impressive results. Analysts forecasting that net sales for aeronautics to reach $7.34 billion. That would be a year-over-year change of about 1%, and those likely from that F-35 jet program. Also higher sales volume in the missile segment as well. Joint to air and surface standoff missiles, long-range anti-ship missiles, and precision fires program likely also benefiting their missiles and fire control segment. Net sales expected to come in there at $3.34 billion. That would indicate an almost 8% uptick from the year-ago quarter. In the space program, higher sales volume from commercial civil space programs driven by lunar program life cycles likely to have bolstered their top line, and a production ramp up in Black Hawk helicopters and the CH-53K programs, along with higher sales volumes from the Canadian Surface Combatant and Radar programs, would likely have bolstered the rotary and mission system segment sales. So all four segments expected to have a positive boost in sales. For rotary and mission systems, they're expected to come in at $4.64 billion, which would be a 2% year-over-year increase. As far as operating profits go, though, aeronautics and space are expected to both post a decline, while the missiles and rotary mission systems are expected to post increases in theirs. Overall, analysts seem bearish on this one, Nicole.
Okay, good to know. A very distinct report there with a lot of information, and the stock right now is at $467 with EPS expected to fall, revenue expected to gain. You tell us, Rick, here about this chart, your thoughts.
So our last chart, the most prominent feature of it was how it was range bound. It's the same situation here, but it's a very different shape. We had a pretty big decline starting with those highs. Then we have a low point here that was held repeatedly near about 420 here. And again, critically, like our last chart, at those April tariff news lows. So that was a significant floor to look for. But the ceiling has been tested many, many times. This red line here, you can see how frequently price has bumped up against this level, which comes in right around 480 or so, and failed to overtake this horizontal line in the sand here. We can also see that for now, it's in confluence with our long-term purple 252-day exponential moving average right around that 480 level once again. You can see as well how sideways our moving averages are, showing weak trend directionality. When they start to cluster together as well, it shows that momentum is low and not really showing a clear lean one way or the other. Now, this might all sound kind of boring here, but low volatility can often be the precursor to high volatility. We have the lines increasingly becoming entrenched here. If we do get some kind of breakout above this 480 level, for example, it could trigger the cascade of orders that would push price up. Then the next level to watch would be here if the gap were to be filled just below 497. If we were to break downward, if earnings come in poorly here, that line 420 or so would be the point to watch. Notice as well how the RSI is getting extremely compressed in this very narrowing symmetrical triangle type range here. We can also see heavy volume here around this level, kind of matching up with our range around the 470 level. An obvious key point for the bulls to clear.
Yeah, and look, I mean, when we think about aerospace and defense, this has been a favored area. I mean, even in Europe, we talked about the new Mag 6, I guess, because there were a lot of European stocks exposed that were defensive as well. But we look at aerospace and defense as an area that people like to invest in, but this has been a choppy chart. How about we talk about, last but not least, Texas Instruments in the semiconductor sector, also on Tuesday. That'll be after the closing bell, Marley.
Yeah, they're after the closing bell. You know, a positive earnings from them expected right now from Texas Instruments. EPS expected to come in at $1.32. That would be an increase of more than 8%. Revenue expected to come in at $4.31 billion, which would be an increase of almost 13% from the year ago period. Now, their second quarter performance is likely to be affected by the ongoing China trade war with the U.S. and those tariff hikes, as Texas Instruments is a major player in China. More than 20% of their annual revenues in 2024 were from China, so that is a potential issue there as well. Also, it's increasing its factory in Utah, so that will incur some costs there. Those rising manufacturing costs and decreased factory loading are likely to have been a major headwind for the company's business in the second quarter, so I think a lot of investors will be looking for information on that. And Texas Instrument results are likely to be positively impacted by the continued recovery in its industrial and automotive end markets, though, and that has consistently contributed approximately 70% to its annual revenues. So that's why we're expecting that almost 13% uptick in revenue is because of that recovery there. And Texas Instruments has surpassed estimates in each of the last 4 quarters with an average upside surprise of more than 10%, Nicole, and their stock's up about 15% year to date so far.
Marley, thank you for that. A lot of fundamentals on these names to watch. Rick, your thoughts on the chart on Texas Instruments?
Our last 2 charts were much more range-bound. This is a stock that's had a strong trend, but now has had a bit of a hiccup here as it approaches old resistance. Take a look here at this red line right around 220. That represents a significant high point from earlier on our chart here. That's about where price got stuck once again. We did manage to make new highs above it, but really no big breakout or no big leg to the upside here. Once again, though, our horizontal lines on our chart come back into prominence here. We can see that the area near 205, old highs here and here and here, that gives us a pretty easy supportive area to keep an eye on to the downside here potentially. We can also see that during this climb to the upside here, RSI did show a little bit of bearish divergence. This is more complicated because it was also in the overbought area, so a bit of a mixed signal there. And now the trend line has been broken, but price is holding on near the 212 level, which represents our recent lows, also our 21-day exponential moving average. So really, if you were hoping for some kind of big breakdown in this name, it has not materialized just yet here. It's also quite common for momentum to slow down into earnings, so this is not exactly unusual behavior here. Nevertheless, a clear upside line, 220. We can see volume here. Price is above our +2 standard deviation channel, so a rather extreme move here. That could be a boundary to consider. Volume really picks up again between about 195 to 205 or so.
Okay. Rick Ducat, Marley Kayden, thank you both so much. A good look there at 3 key names. We really appreciate it. Texas Instruments, Domino's Pizza, Lockheed Martin. We got you covered here on Schwab Network. Thank you.